Hi, welcome to the Quant channel. So today I just wanted to look at the most bearish chart for the US economy. The basic idea being that people follow the profit margin. So when things are good, you make something or do something and people are willing to pay a premium for what you did and you make profit. So in the good times, the profits surge, and you can see there's, the green line is the profit margin, or say the return of equity. The yellow is the profit margin. And for us as investors, it's the return on equity. That's the factor that will come into play, because that'll affect. No. So when the profit margins stop going up and break down, the stock market falls. As it says here, that's the dot-com bubble, that's the financial crisis. I'd more be aware of the dates. So this would be the period where it collapsed. In the bank crisis, the financial crisis, this is the period during the dot-com. So it's an easy sell, when companies are making, there's a very nice profit margin. You can go out there and say to investors, lend me some money, I'll make more money, we can make more money. But when your proposition is lend me some money, I need to pay off debt, I'm not making any money, then that's a harder sell. So the main point is we are seeing a fall down in the profit margins. In particular, it's broken below the recent low. So this is a lower low. If we look at the previous cases, it fell a bit here, it hit a higher high, but when it broke below the previous low, it just collapsed. Likewise here, once it broke below the previous low, it collapsed. And we had, the financial crisis stock market fall and the dot-com stock market fall. This time, it's broken below the previous low. We'd expect it really to have a big fall. So we'd want to be short. Remember, I just posted a video yesterday about how we're hitting record highs in the stock market. So, it's just the different signals that we're getting. This is another one along the weird setup, why people are uncomfortable. Because we're in this period of zero or near zero interest rates. And that just distorts things. Like the Fed were preparing to tighten up a bit. That's covered in this article, because they are uncomfortable having interest rates so low, if they'd been able to hike a bit, then when, you know, you might nip various bubbles that are occurring, misallocations of resources and that kind of thing. So I'll have the links to these below the video, so you can, you know, look into it in greater depth yourself. This is what I was going to talk about. I mean, like, I knew I wanted to create a video on this yesterday, but then it just doesn't stop. So we had this mad report, I'm in Ireland, in the Irish news, and everyone's kind of scratching their heads and feeling uncomfortable. Ireland's GDP grew by 26%, which is as nonsensical as it gets. As Ireland's Central Statistics Office told the World this week that the country's economy grew 26% in 2015. So they're just scratching their heads and trying to explain why, you know, why to ignore that. So again, I'll have the link to this below the video. There are various things going on which are particularly prominent in Ireland. So just as we're dealing with reports of 26% growth in the GDP, I mean, there are weird things. So, you know, like with the inversions. So we had these big companies that used to be based in the US moving to Ireland, and so then they are Irish companies, and even though, you know, they're still the same as they were, so legally they're Irish companies, but, you know, the owners and everything, it's still the same company. But that gets reported, that's added to the Irish GDP now. So there are all these kind of things going on. So, but at the same time, so the same week, same day as I listen to the radio news and stuff, at the same time we're having spectacular 26% growth, we have a homelessness crisis. Essentially, you know, during the housing massive boom, lows after the crash, banks and anyone working in construction got wiped out. So since essentially 2007, 8, 9, you know, all those guys went out of work. No, you know, you have no chance if you want to work in construction and, I think I want to build a housing estate. The banks are desperately trying to get rid of billions worth of loans they have on property. But, you know, like we have with the oil, you know, you have loads of oil rigs and businesses going out of business. That means there's basically no capex going into it. Rapidly, you know, you're not going to be discovering new oil. You're not going to be you're basically going to run out of supply down the line. And that's kind of what happened or is happening with houses here. So there's no housing being built, and rents are shooting up, there are no houses. And you can't just build houses in an instant. And just to show that it's not just weird stuff going on in Ireland, JP Morgan just made a fortune. Now, I just caught this on CNBC this morning. This guy was talking about how we really don't understand banking. So, the whole thing's supposed to be that we're in a period of low interest rates. We're in a period where essentially banks shouldn't be able to make any money. So banks' shares have been falling. It's all doom and gloom for banks. Yet JP Morgan made a net profit of 6.2 billion. The guy was saying JP Morgan was the second most profitable company in the S&P. So this is what we're having, or this is what we have to deal with as investors, as quants. What is my as quants? I'd like to be able to look at a system, get some data, measurement, and then using R, for example, which we were looking at, visualize it, plot it, see whether we can see structure patterns within it, and then be able to profit from it. Because if we can see patterns, we can kind of go, okay, the likelihood of this happening is, say, 70%. Using Kelly, we can estimate how much we should invest. So if we bet on this investment, I reckon I can double my money with a 70% probability. So then I should bet 40% of all my resources. That kind of thing. So a nice, orderly structure. But here, what are we supposed to be looking at? What numbers make sense? I mean, do I use this 26%? But can I ignore it? I mean, if I just go, I'll ignore it, why am I using the other data? I mean, this is the correct official GDP number, using the same methodology, the same calculation as is done everywhere else. So how come we just picked this one out? So that's what I wanted to talk about today. Till next time. Oh, and as always, if you have any interesting links, comments, or even thoughts about how you process this, how you structure a deal with it, just put them in the comments below the video. Thanks.